All right. So today we're going to talk about some of the Chapter 9 material. And again, really, it's important that you look at the playlist first, the playlist of Chapter 9 videos. That provides the lecture, the foundation behind what we're talking about. And I will do a little bit of a review on it just because there's some important concepts that underpin, why we're doing what we're doing, why companies choose to do this. So really if I could, describe a lot of these topics in a nutshell, or at least today's topics, LIFO liquidations, LIFO reserve, this is all underpinned by the desire of companies to report using LIFO. And as I said on the other video, 60 to 70% of the dollar value of all inventory is reported under LIFO. So there's a strong preference to use that instead of FIFO or weighted average cost. Now, LIFO is desirable to report. So it's the preferred reporting method. But companies don't like it in terms of recording at times. So companies want to report using LIFO. And when I say report, what that's going to ultimately impact, all cost flow methods impact in the inventory account and the cost of goods sold account. So when we're reporting using LIFO, we're reporting inventory on the balance sheet, we're reporting inventory on LIFO terms. On the income statement, we're reporting cost of goods sold under LIFO terms. And that's great for reporting, but LIFO is problematic for recording. It can be problematic for recording transactions during the period. And for this reason, companies may decide not to use LIFO, but use, for example, FIFO instead during the period. But there still is this strong desire to report using LIFO. And so, really, what it amounts to is the company does its own thing with a different cost flow method during the period, allocates costs in that fashion during the period under, say, LIFO or average cost. And then at the end of the period, they make a single adjusting entry that will shift their inventory and cost of goods sold account so that it is reported under LIFO instead. And the whole reason for this is LIFO confers tax savings. And it does so because typically in times of rising inventory costs, it reports higher cost of goods sold. And that in turn produces less pre-tax income and therefore lower tax expense. Now you might think, well, why? Why are they willing to save on taxes? Because the ultimate, perhaps undesirable result of this is lower net income, right? We are reporting less tax expense, but we're not going to be reporting as much net income because higher cost of goods sold, sure, it pushes pre-tax income down, it pushes tax expense down in proportion to that reduction to pre-tax income, but this all will result in lower net income. So why is it that companies want lower taxes even though it results in lower net income? And the answer is that taxes are paid in cash. And net income is an accrual number. So what companies want is the tax savings today right? Because money has time value. So we want a dollar today rather than getting that dollar tomorrow or worse, a year from now. We want the money today. And if our tax bill is costing us cash, we'd rather have less money spent today than we would want to report accrual profits. Remember that this is just all a moment of accrual accounting. And that's big to understand. Hey, we're not shifting when we choose a cost flow method, we're not shifting our true profitability. We are messing around with cost of goods sold because different cost flow methods will produce different amounts of cost of goods sold. But this is not a real cash effect. This is an accrual effect. Um, Albeit these accruals give us some tax relief. The reason why companies won't report FIFO on their books and LIFO to the tax authorities, because those are two definitely different systems, right? Um, we do not necessarily have to report for our taxes exactly how we're reporting for our financial statements, except in this one case, and that is with LIFO. If we report with LIFO, then we have on our taxes, then we have to report using LIFO on our financial statements. And that comes from the LIFO conformity rule, which aligns tax reporting with financial statements. And you'll get more into this in intermediate two if you do take intermediate two, that there are many cases when we allow these two systems to diverge. I mean, the FASB presides and makes the rules over US GAAP. US GAAP is what tells me how to report on financial statements. The IRS is the regulatory body over the code, the tax code, and the tax code is ultimately set by politicians, right? So they're two different systems, two different agenda, and they can vary except in this one very important piece. And this wouldn't be such a huge deal if cost of goods sold was less less of a significant expense, but cost of goods sold tends to be anywhere from say 45% to 55% of the revenues reported by businesses. So it is the major player, even more so than taxes, in terms of what expense companies report when they're a retailer, wholesaler, or any company that records cost of sales, cost of services. It's a huge player. So back to this idea of companies don't love recording using LIFO. They do love reporting using LIFO. And this is where the LIFO reserve comes in. The LIFO reserve is a contra asset account, and we have its own account. We want to make it a contra asset, just like the allowance for credit losses, just like accumulated depreciation. We want it separate from the inventory account, very much because if we are recording our during the period transactions with no LIFO, then this inventory account will be totally in non-LIFO dollar value. So we'll actually measure all our sales, allocate the inventory cost, say with FIFO or average cost, and maintain that record here purely in the non-LIFO dollar value. At the end of the period, we use this contra asset account to lower the dollar value that is reported under the non-LIFO term. Because typically under LIFO, two things happen. We talked about the increase in the cost of goods sold, but really two things happen during rising inventory costs or periods that have rising inventory costs. Under LIFO, we report higher COGS and lower inventory value. So this contra asset tends to bring down the inventory account from non-LIFO to LIFO. So when we're thinking about this process, it does help to keep the accounting cycle in mind. If you're thinking of like steps 1 through 3, we are reporting, like I said, recording COGS and inventory under non-LIFO terms. Then we get an unadjusted balance for inventory, an unadjusted balance for cost of goods sold. And then in step 4, for adjusting entries, we make an adjustment using the LIFO reserve to obtain LIFO, COGS, and inventory. And then and that doesn't happen again until step 6, or we don't have any real action going on until I wrote step 5. Step 6, when we're making the financial statements, report the inventory at LIFO. And we're going to do that by taking the inventory balance, the balance of the inventory account, and subtracting the LIFO reserve balance, just like we do when we report net realizable value for our receivables. We take the accounts receivable and subtract off the allowance for credit losses. But in this case, we're taking the inventory balance and subtracting the LIFO reserve balance. So during the period, everything is in non-LIFO terms. Step 4 is the adjustment to this account so that those terms, those non-LIFO dollar values, can be converted into LIFO terms. And then we report inventory at the LIFO amount on the balance sheet after that's done. So I want to take us to a problem. And it's in the chapter 9 problem set. It's the first example. First example, but number 2. So we're estimating the LIFO reserve. And it says that the company records its inventory ledger using a FIFO cost assumption. At January 1st of 2020, the balance of inventory according to this measure is 100,000, while its ending inventory is recorded at a balance of 170,000 at the end of the year, December 31st, 2020. So again, I'll just construct an inventory T account so I can get the lay of the land here and make sure that I'm lining everything up correctly in time. So I have $100,000 of inventory here at the beginning of the period, and then a lot of transactions happen during the period. I'm not sure exactly what. It's not part of the problem. But the result of all those transactions is that I end up at a $170,000 balance at the end of the year. And that's 1/1/20, and this is 12/31/20. It says that the company does use LIFO to determine taxable income, and it estimated that its inventory balances under LIFO would be 60,000 and 90,000. And I don't have it in the problem, but going with the idea that it's respectively following along the lines of 60,000 is my beginning value. This is my ending value. I'm not going to do another T account because remember, if we go back to what I was saying at the start of my lecture now, that the inventory account, this ledger account, is always in its non-LIFO value. we use the life of reserve as a way of the as a way of holding data in a separate compartment to modify this when we need to. And we don't need to modify it until we're reporting on our balance sheet. So the ultimate result is that our LIFO values are only on a balance sheet. So this is a balance sheet where I'm only showing you the one account, one asset line item, and we report balance sheets at the end of fiscal years or at the end of accounting periods, but for this one we have a fiscal year. And so we would have a balance both at the end of the prior year and a balance at the end of the current year. So it said that the balance at the beginning of the year, at the end of the prior year, was 60, and the balance at the end of the current year is 90. This is LIFO amounts because we're talking on the balance sheet, it reports under LIFO dollar value. This is not LIFO, this is FIFO. So how we get to these numbers from these is the role of the contra account. If we had a $100,000 inventory under FIFO, but now we have a $60,000 inventory amount under LIFO, we must have subtracted 40,000, which means that the balance, the beginning balance of my LIFO reserve account must have been 40 because all we're doing is taking the balance at a date here minus the balance at the date here to get the result over here. Same piece, we have an ending balance of 170,000 under the FIFO, but 90,000 under LIFO. So we have to subtract 80,000 to get from FIFO to LIFO inventory, which means that this ending balance at the same date is 80,000. Okay. So what the first question is, it fires. If cost of goods sold using a FIFO assumption was $400,000 for the year 2020, determine the amount of cost of goods sold to be reported using a LIFO cost assumption. All right. What we need then is the adjusting entry here because these balances only tell me how to reduce the asset, right? This is asking me about cost of goods sold, which is an income statement account. So these two aren't going to directly tell me anything, but what I will get from those two balances is I must have made an adjusting entry here in step 4 that would take my LIFO reserve from 40,000 to 80,000. And so clearly it's a credit to LIFO reserve. You do not credit inventory because if we credited inventory, then it would no longer be in FIFO terms, right? We want to keep this data in this ledger in integrity with the FIFO system. We don't want to directly change it, so we change the reserve to get to the amount we need in order to report under LIFO. Because it's a contra asset, a credit to this account reduces assets. Now the question becomes, what do we need to debit? And the answer is quite simply cost of goods sold. And we debit cost of goods sold, which effectively increases cost of goods sold, which aligns again with what we generally expect from LIFO under times of rising inventory costs. Again, going back to my primary portion, kind of opening lecture here, rising inventory costs under LIFO increase cost of goods sold and reduce inventory. And that's exactly what this adjustment is doing. It's increasing cost of goods sold, reducing my net income, and increasing the life of reserve, which as this number goes up, it's a contra asset, reduces my inventory asset further. Okay. So this is the amount that moving from FIFO to LIFO increases cost of goods sold by. If I was using a FIFO cost assumption, under that, my cost of goods sold account is at 400,000. So this would be its basically its unadjusted balance. It's still in a FIFO at the unadjusted because we haven't made the change that will introduce the extra cost of goods sold under LIFO. Now we debit it by the 40 we debited here. I'm sorry, credited up here. It's debited down here in cost of goods sold. And we end up reporting $440,000. This is LIFO cost of goods sold. Now, does this always have to be a debit to cost of goods sold, a credit to LIFO reserve? No, it does not. All right. These will always be the two accounts for sure. Now, sometimes you might debit LIFO reserve and credit cost of goods sold. And that could happen if inventory costs go the other direction, if they stop rising over a period of time and they actually fall over a period of time, then this entry could be reversed. It could be kind of a hypothetical moment here. It could have been that my LIFO reserve, let's say, went from 80 down to 20. I'll make different numbers just so we don't get the same repeating. But so this suggests that basically there must have been a reversal in the trend of inventory costs over time. Well, in order to go from 80 to 20, then we need a debit to the LIFO reserve. And the debit to the LIFO reserve will trigger a credit to cost of goods sold. And since inventory costs are going down over time, it actually reduces or credits the cost of goods sold account. Because if I credited this count, it was at 400, say, debit balance. I credited it by 60, it would report less cost of goods sold, 340, right? So this can happen for sure, depending on what inventory costs are doing, how the company is purchasing its inventory, its pattern of purchasing inventory can sometimes make it happen, but it is completely feasible for this entry to go either way. What will tell us is these balances. And the other super important piece to working to understanding LIFO reserve and really setting it up, and it's a little clear here, but I'll spell it out for you. In order to figure out what these balances were, we looked at, well, what is the FIFO balance at that date? What is the LIFO balance at that date? Take the difference. That's the balance here in my LIFO reserve. So these two balances, and just the balances, mind you, not the adjustment, but the two balances are the difference between the non-LIFO and LIFO inventory balances. So if I have certain problems where I just tell you what the balances are or what the balances are under non-LIFO versus LIFO for the inventory account. From that information, you can set up a LIFO reserve with two balances and then say, oh yeah, all right, I need an adjustment, either debit or credit. This is my adjusting entry, and this is how it would roll forward. The second question on this problem asks, have inventory costs increased or decreased over the course of 2020? And this was the hypothetical that we did. This was the problem itself. If the LIFO reserve is growing, then in um, all indications would point to that inventory costs are rising over time. Because what we're basically saying, if you kind of go back to this idea that these balances represent the difference between non-LIFO and LIFO inventory, if the balance grows from 40 to 80, that means the difference reported under LIFO and non-LIFO has grown over this time period. And typically, how this grows is inventory costs rising. And then the third one, I kind of want to save. This one is a practice. This is a question I ask on the practice set, and the practice set gives you the inventory turnover ratio. It tells you what to feed into the formula, and then asks you like, okay, this was the inventory turnover under FIFO. This is under LIFO. What happens to it? I mean, I can show you just to kind well, for people that want to watch this, they'll get this one pretty fast. I'll go ahead and talk about it a little bit here. This is the inventory turnover ratio. It's cost of goods sold divided by beginning inventory plus ending inventory divided by 2. So it's looking at it's an inventory management ratio. Again, if you want interpretation, think about the extremes. If I had, say, $1 billion cost of goods sold during a period, that means I sold things during the period that cost me $1 billion. Well, every dollar that's in cost of goods sold was in my inventory accounts. And so if, say, my inventory account at the beginning of the period is $1 and at the end of the period is $2, right? $3 divided by 2, that's $1.50 divided into $1 billion of COGS. That's a large number, right? A little less than a billion, but not a whole lot less than a billion. And what that implies is we're keeping really low stores and values of inventory, and that's a good thing because we're selling the hell out of it, right? Um, and that's really the goal of a business. Most businesses engage in just-in-time inventory systems because it's costly to hold inventory. You can have shrinkage, things can go bad, stolen, you have to store it, right? All of these things cost money. It is much more in the interest of businesses to buy inventory and have it move off their shelves relatively quickly. If we have the other extreme where we have, say, $1 cost of goods sold and $1 billion of ending inventory, average beginning and ending inventory, then it's clear that we're holding a ton of inventory and unable to sell it at all. $1 divided by, say, a billion down here is going to be an infinitesimally small turnover. And so the bigger the turnover, the better indicator for inventory management. Now, what the sort of application piece is, and this is the part that I won't answer directly, but you can kind of figure it out pretty quickly with the pattern of rising prices and rising inventory costs and all that. Um, Cost flow methods affect both cost of goods sold and inventory accounts. So if one company is operating under FIFO and another is operating under LIFO, and they have the exact same cash flows from sales of inventory, that doesn't matter. They will post different turnovers because of their cost flow assumption, right? One will look better than the other, even though in truth they're moving and getting the same amount of money for the inventory they're selling. So that's essentially the LIFO reserve. I would tell you there is a lot of places where you can practice it, where it's embedded. Example two embeds it in a uh, and a problem that's a lot like Chapter 8. I like this problem because it combines the Chapter 8 and the Chapter 9 material. Same thing with example 3. It's a combination of the Chapter 8 and Chapter 9 material that I think is very useful. And then finally, example 4. This is one of those cases where I give you, oh, this is the ending value of inventory under LIFO versus FIFO. Tell me about cost of goods sold if we report under a LIFO method. So all of those are good problems to work and to practice on for that.